Hello and good morning, everybody. Welcome to today's boot camp where we're going to talk all about position sizing, risk management, how you can construct low risk, high reward trades and manage them in your portfolio too. A difficult thing that a lot of traders face is that point where you start to see trades popping off all over the place, and you're eager, you want to dive in,
I've seen
and
it.
hello. It sounded like somebody was chatting. I'm going to open up all the microphones too, and Jovan, if I said your name correctly, let me know. Um, but yeah, all the microphones are going to be open for this boot camp. Um, I want it to be something that is highly interactive. If you have questions about anything at any point, by all means, jump in. The only thing that I ask is that you keep your questions to whatever the topic, whatever the slide is, and uh, there'll be plenty of time for additional Q&A on unrelated topics at the end. If you want to use the chat box, just take your mouse, scroll it around. You should see a little chat bubble down at the bottom. In fact, well, why don't you just let me know that you could use it, type something in, let me know where you're from, what you're hoping to learn today. Type something in there. Let me know that you got it, that you could hear me, and that all this is working well. All right, so let's get into it then. All right, so I'm going to begin sharing my screen, turn on the slideshow, and let's do this. All right, so actually, I think that we want to share this other screen over here. Make that bigger. Perfect. All right, so what are we learning today? Today, you're going to, again, learn how to leverage trades without taking on a ton of risk. So we're going to focus on developing high reward, low risk trades. We're going to learn how to leverage our trades without taking on tons of risk. And we're going to learn how to manage our overall portfolio heat. Again, like I started to say, well, when we first opened up, it can be really tempting to dive all in to the market when you start to see lots of trades popping off super fast and get overexposed too quickly. And we're going to talk about how you can manage your overall portfolio heat, the overall risk that you have in your portfolio, and make sure that it doesn't get too hot where you're going to get burned. You're going to design position sizing strategies to meet your individual goals too. We'll talk about like everybody's goals are going to be a little bit different. Somebody might want to not take on as much risk as somebody else. Somebody might be a little bit more conservative. Somebody might be more aggressive where they want to take on risk, like say 10% of their capital at any one period of time. We all have different risk tolerances. And so we'll discuss as well how to design a position sizing strategy for your account and help you get to where it is that you ultimately want to go. So some of the prerequisites that we need to talk about first, just to make sure that we're all at the same place, is setting your entry point, your stop loss, and your profit target. The reason why is because these are the key ingredients to position sizing. You need to know each one of those. So, well, basically what we're doing, it's kind of like it's kind of like entering an address into the GPS of a car. The more the information that we give it, then we could reverse engineer how to get there. And so the same thing goes with our position sizing. If we know our entry, if we know our stop loss, and if we know the profit target too, then that's going to tell us a whole bunch of things. It's going to tell us one, if the trade is even worth taking, right? Like, because if your target is, let's say your target is $110, right? And you're entering the trade at 100. Now, let's say, just for this example, your stop loss, you evaluated the trade and the stop loss is all the way down at 50. Well, that's not going to be a trade worth taking, right? Because you wouldn't risk $50 to make 10. So there's that factor of it. But assuming that the trade works, then you'll be able to back into the number of shares that you could buy based off of where you're going to enter and where you're going to place that initial stop loss. And we'll talk about designing that actual trade and show you some tools that you could use to help you do that, so that way you're not sitting there with a pad and paper or have to do anything in Excel. We've made it super simple. You'll also be able to measure your risk in individual units. So rather than thinking of like, oh, well, I'm risking 5% on trade number 1, I'm risking 7% on trade number 2, maybe 10% on trade number 3, and then trying to figure out, well, what's my total exposure in the market? Well, we're going to look at risk a little bit differently now. Well, we're going to measure risk in individual units that we're going to call R, and we'll get into what this R, like how to manage it, how to make it. But essentially, it's what we're going to be doing is managing each unit of risk as one R, right? So if you are, let's say you, same trade as before, you entered at 100, you have your stop loss at, let's say 90. That $10, that's going to represent your initial risk, that one R. And then you'll be able to look at all of your trades in terms of R multiples, and it'll make it that much easier for you to manage your portfolio heat, which will and be able to raise or lower it kind of like you would the heat on a stove. So the first thing that we're going to do is we're going to start with the setup. And I also want to throw out there too that this kind of position sizing will work for any kind of setup, whether you are a long-term investor, whether you are a swing trader, whether you are a day trader. Position sizing works for any of those. All of us here are trading stocks or options. This also works for Forex, it works for crypto, it works for baseball cards. Anything that trades, you can figure out your risk in terms of this formula that we're going to learn. And also, in regards to the setup, we want to find strong setups. We want to look for a confluence across time frames, and that's one of the ways that we look for these stronger setups. If you've been to our weekly deep dive sessions, especially the part where we're going through individual trades, starting to dissect them with that new tool that we've developed, that trade evaluator tool. Like that's how you are going to find the strongest setups. And we'll actually take a look at some of that during this presentation as well. Any questions on anything so far? All right, so let's talk about an example. Right here, we've got PayPal. Now we're looking at two different charts. We've got the weekly chart over here on the left. We've got the daily chart over here on the right. And now let's just zoom in to that weekly chart. And so this is a chart going back a couple of months now on PayPal, but what it had was this classic short stroke pattern where it had this run up starting from back here, and volume started to pick up on the up weeks, and then it had this massive breakout from several months. Actually, it could have been close to about a year of just basically consolidating sideways and then breaking out on that monster volume. Then from there, to complete this short stroke pattern, what it did was it had this very short, especially relative to this bar over here, very short bar, and that's what makes the short stroke pattern. And the volume also came on significantly lighter volume than the week prior to it. And that's why it started to give us that that high reward, low risk setup right here on the weekly chart. Some of the other things to look at this as well is the relative strength line accelerating too. Relative strength was at fresh highs. So that's what it looked like on the weekly chart. Over here on the daily, this is where I like to look for entry points. If I am taking a swing trade, I'll look to execute on the daily time frame. If we were doing something longer term, you might have executed back here based off of the weekly chart, and maybe you're not even looking at the daily chart like that. That's acceptable as well, depending on what your systems are. If you are somebody that is doing a little bit shorter term swing trading where you're only going to hold for maybe a couple of days and you're looking at hourly charts, then maybe you're looking at a weekly time frame, a daily time frame, and maybe you're going down into the 2 hour or the 1 hour charts to find your specific entry points. All this would work on those time frames as well. Same thing for if you are a day trader and you're looking at, say, a 3-minute chart, same principles all apply. So over here on this daily chart, what I was seeing was we had the breakaway gap, and then the breakaway gap also helps us find the entry point and sets the stop loss too, because now we've got resistance at this level here, which happened to be 147.60, and it's the same as the short stroke on the weekly. And then over here for the stop loss, below the low of the gap, and that was also lined up very well with that second week of the short stroke pattern. So having one layer of confluence, the low of the gap, the second layer, that second week of the short stroke pattern, that being this low right over there, that being tested and held, then you have then you're getting ready to buy it right over here, and at that point you have two different moving averages giving support. You have the 5 EMA and you have the 10 EMA. So that means that if this did reverse, that it would need to fall below the 5 EMA, fall below the 10 EMA, fall below that weekly low, and also take out the low of that breakaway gap that happened on that massive volume. So when you have all these different layers of confluence working for you, it makes the support level something that you could drive a truck over. And the reason why I'm kind of belaboring this point about finding this kind of structure, it's because that's part of what creates the high reward, low risk trade, and it gives you greater probability of your trade actually working for you. Like over here, right? Like it broke out, ran a little bit, reversed, and then came back in with just like a few cents of the stop loss on that day. And yeah, it did fall below the 10 EMA. It did get below that 5 EMA too, but look at what it held. It actually held that low from the short stroke. It also held the low, of course, from the breakaway gap, and then reversed and closed higher. So knowing where to place your entry and where to place your stop is important. And it also gets factored into how you will position size. This trade happened to be a approximately 6-to-1 reward to risk for that trade. So the target on the trade was 200, which was approximately 20% above the stop loss. So what that's telling us is that, yeah, like if you just look at this, the entry point, the 147.60, and that stop loss, that 138.90, and you're treating that as one unit of risk, well, there's 6 units of risk that you would be rewarded with if price moves to your target of 200. Does that make sense? Pretty straightforward, I think, but feel free to jump in at any time. So with all that information, now we're able to calculate the risk, right? So we have our entry price of 147.60 minus 138.90, and that's giving us the risk, the R multiple, $8.70. Then we could calculate what our total risk on the trade is going to be, right? Like you could figure out how many shares you want to buy. And you could just, like if you're using a round number, like say in this example, we just used 100, you're risking $870 on that trade. What you could also do is this here, and let me stop sharing the screen for a moment and give you 2 other tools that will help you. A position size calculator and also this trade evaluator. And you may have seen both of these on some of the deep dives if you've been to either of those, but we'll take a closer look at them right here and go into a little bit of explanation of how they work. So let me stop sharing this and start sharing screen number 3. All right, so if you just simply were to go to marawolf.com and scroll to the bottom under tools, there's this right here, position size calculator. And this is a free tool. It's free to everybody. You don't need to be a member in order to use this. But let's say you wanted to take that trade, and let's say that you had let's say that you had $100,000 in capital that you're working with, and now you needed to figure out what unit of risk do you want to operate with. I like to use percentages. It makes things a lot easier. So how much of your capital are you willing to risk? Typically, I would risk 1% of trading capital per trade. So risking $1,000 per trade, and it keeps each unit fixed, and it makes it so much easier to manage. And when you go to look at your trading system and you have a certain expectancy for your system, meaning that you've taken let's say you have 30 trades, or let's say you have 50 or 100 trades, and you look at all of the wins and losses of those trades, then you have a certain expectancy. You have the average win on each trade, and it's from there that you could extrapolate that to say, okay, if I were to trade this system in the same way 100 times, this should be my result. And when you are keeping your risk constant by using a set percentage of your capital, just simply like 1%, then it makes it that much easier to manage and to win. And from there too, you could also back test different position sizing strategies. So let's start off with this example here. Let's say that we put in 100,000. We're going to risk 1% of our capital. We were entering at 147.60, and our stop loss was at what was it, 138.90, I believe it was. So what this is telling us down here is that we bought 115 shares, right? Like you just, yeah, for that you're rounding up to 115, and you're risking, or your position size rather, you're not risking, you're only risking this down here, right? You're risking about $1,000, and your position size is about 17,000. So 17% of your capital just went into this trade. So at this size, at this risk, like you have so much information here, right? Like you have, you know that if, let's say you bought 5 other trades the exact same, yeah, well, now you could, you're basically fully invested with 5 different positions. But let's say instead of using 138.90 as your stop loss, let's say you found a higher level of support and you wanted to use that. Maybe you're using the same entry price, but let's say you're not swing trading this. Let's say that you're day trading this, and you found an entry price that was, or a stop loss, I should say, that was like at 145, right? Now all of a sudden you're buying 384 shares of this, or 385, and you're putting more than half of your account into this. This is telling you that you're being way too aggressive if you are swing trading, if you're holding it overnight, if you're going all in on your account and you're holding overnight. Yeah, well, like you're exposing yourself to a significant risk if the trade were to gap down against you the following day. You wouldn't be risking that, like you would be exposed to something that would be greater than 1.7% of your risk. You would be, you could potentially be out 5%, 10%, and then all of a sudden you have quite a bit of ground to make up. So part of the idea with this tool is that you don't want to be overexposed, and part of what this is going to tell you is if you are someone that is holding trades overnight, this part here, the trade emotionator, is telling you whether you are being overly aggressive, or if you wanted to go to the other extreme, if you need to grow a pair. Because if you have your stop loss 30% away from your entry price, then that means that just to make 2 to 1, you would need to have this trade move up 60%. So it's not going to be worth it, or you won't reach your goals quickly by doing that. Let's take a quick look at the trade evaluator. I still have this in demo mode. We are releasing a full version of it very soon. The tool itself is fantastic, but some of the things that you're able to do with it is to calculate your reward to risk. So let's say that we were trading PayPal and we had our entry at 147.60 and our stop loss at 138.90 and our target at 200. That's giving you your reward to risk. It's also telling you like how much profit that you would expect to make on this trade, and how much you're risking on a percentage basis, how much you're risking per share. And it makes it simpler for you in order to make these calculations. Because a lot of great things that this tool helps you do, as far as that, like figuring out if the trade is even worth taking. Like if we were to go through all this, and we won't, it's a little bit off topic. Maybe if you wanted to go through this at the end, we could, but part of what this tool does is you would go through, evaluate each part of the trade, and then it would give you a score at the end. And based on the score, you would then be like, oh, like this is a trade that matches my system and I want to take this trade. Or you might look at this at the score and say to yourself, wow, that's actually a pretty low score. I think I'll pass. Let's come back to this over here. All right, so knowing our what our R is and what our reward to risk, we know if the trade meets our minimum reward to risk. Knowing if a trade meets your minimum reward to risk is going to be important. And the reason why it's important is because when you have your trading system, you need to know what's the average amount that you tend to make per trade, and are you giving yourself enough profit potential in each trade in order for your system to be viable. Some of the greatest traders of all time tend to aim for at least 3 to 1 reward to risk. Minervini aims for 3 to 1 reward to risk. O'Neill would aim for 3 to 1 reward to risk. Paul Tudor Jones aims for 5 to 1 reward to risk on every single trade. For me, I'm looking for at least 3 to 1, and if I'm able to get find 4-to-1, 5-to-1, sometimes 6-to-1 reward to risk trades like we saw with PayPal, then those are amazing. And that's where I'd want to put my attention and filter out the rest of the noise. It's also letting us know when we've made a full multiple of what we've risked too. So that way we could decide how and when we want to start taking some of those profits. There's a lot of different ways that you could look to take profits in your trade. You could very simply, just to go back to this slide here, actually, let's do this one. You could just say you entered at your entry point at 147.60, and you could just say, I'm either going to sell at 200 or I'm going to take my stop loss and leave it at that. Plain vanilla, super simple. That's not what I would recommend. I like to have multiple exits to each trade, kind of like if you were to go to a theater when they finally reopen, they've got multiple exits all around the theater. You want to give yourselves multiple exits on your trades too. So for me, some of the ways that I'm doing it, like I'll have trailing stops, I'll have back stops where once a trade advances, I'll raise my stop up below different levels of support. So what I would do, and let me grab the little drawing tool on here. Like, well, once PayPal is breaking out over here, then I can raise my stop to this level right here because it made it broke out of structure and it formed a new significant low. And then when it's breaking above here, I'm looking to raise my stop again, and both of those are backstops, or what I would call backstops. It's not the only thing that I'm using to exit a trade either. I like to use trailing stops. I'll use different moving averages like the 5 and the 10 and the 21, not just to quantify the move, but to also, if PayPal is in this trade closing below those moving averages, then I'll use that to start to scale out of the trade as well. And also sell into strength. There's a lot of different ways that you can manage a trade. And what I would suggest that you do would be to backtest all those different management styles. So the way that you could backtest it, and actually, since I'm going off on this tangent just a little bit, let me show you a back test that I'm working on right now. Let me put this up here and switch screens again. These are some of the trades that I've taken this year, but I wanted to see what would happen if I managed them in a different way, where if I dedicated 30% of my position to trailing stops, 20% of my position to those backstops, a minimum of that, because well, let me explain this part, and 50% to profit targets, right? So 50% is hard, dedicated to profit targets, 30% hard, dedicated to trailing stops, and then if it never fell below that price structure that we just spoken about, then that last 20% would just run forever until the trade broke below a significant support level. But the backstop is also in place too, to if price starts to retrace and fall. Let me switch back just for a second. So let's say price were to fall below here, then I would exit the entire trade rather than letting that trade continue to run, because it made a significant low, which should not violate that. And if it does, then I'd rather move on to another trade. But to go back to the back testing is so important. I can't stress that enough. Back testing will tell you how different management would result. So far, I have 22 trades that I've tested here, and managing it in this way would have resulted in 11.8 R on those 22 trades. On an account of 100 grand, it would have made $11,801 so far. I've still got a few more trades to test and a few more to add. And it's averaging 0.54 R per trade. So it's figuring out too, like you want to have a set of rules that you're going to follow, and like there is no one set of rules that are right, one set of rules that are wrong. It's about developing rules and a management strategy that is going to help you fit your objectives. So the first thing that you would need to do is gain clarity on what it is that you want, what you want your trading system to be able to do for you, and why you want that. And then to also have clarity on what your trading beliefs are, because if you've built this system but you don't, your beliefs about trading or your beliefs about money differ from this system that you have, then you won't be able to execute it. And you also need to think about what you are able to execute well, because let's say you came up with this and you're like, wow, like I'm making half an hour per trade. I just need to get more trades in the system and it's going to be great. Well, are you able to manage more trades at a certain time in your system? It's an interesting question, and only you'll be able to answer that. So back testing, extraordinarily important, and helps you answer a lot of questions. Let's switch back to screen number 5. Finally, it's going to let you know how much risk you're carrying in your entire portfolio. Now, let's say that PayPal trade went off, and then all of a sudden a trade in Tesla goes off. Then, like right now I'm carrying 4 different trades, and understanding what my portfolio heat is at any given time is going to be crucial, right? So just to walk through this PayPal example for another moment, if we're taking our profits at each of those R multiples and raising our stops, then that's something that would lower the portfolio heat. All the different trailing stops, so we spoke about that a little bit already, with them working as a time-bound stop. We spoke about the momentum that the moving averages are displaying simply by the price being above them. And yes, having multiple trailing stops as well. Yes, and this is important too. If you are somebody that is going to use moving averages, only use the moving average on the time frame that you're executing on. So if you are, let's say that you executed a trade on a daily time frame, but you're like, oh well, I'm going to wait until the end of the week to see how this trade, like if it bounces off the 10-week line, that's a trap, right? Because you executed on one time frame, stick to that time frame, because otherwise, like it could continue to fall, and it ends up being a psychological trap. Yeah, on this particular trade, this is how I ended up managing PayPal with the different EMAs, selling a little bit at the 5, selling a little bit more at the 10, selling a little bit more at the 21. And again, like you can go back to your trading, set up a spreadsheet like the one that I showed earlier, and go through it and just test different strategies for your trades and see what would have worked. Like come up with your idea and then just go back and see like what would have happened if I managed these set of trades differently, and then you'll see like what the result actually would have been, and then it'll give you confidence to be able to actually go and execute on that idea. And if you do have a string of losses, you'll see it very clearly, and you'll understand that that's part of your system, right? Like just to go back and show you this for a moment. In the beginning of the year, right? Like here, there's some heavier losses, some gap downs that happened. Then here's 4 more losses in a row, a couple of winners, then 3 more losses in a row. Like overall, there's more winners than losers here, right? But the system is still very profitable. So it's goes back to having that high reward, low risk strategy and being able to cut losers short. Like many of the losers have less than 1R loss in them. It's another thing that allows us to compound more. Let's go back to screen number 5. All right, spoke about backstops. All right, and let's talk about portfolio heat. So big part of the reason why we want to manage our overall exposure, and now that we have an idea of what this unit of risk is, it can, if you're risking 1% per trade, and that's you're using that kind of position sizing strategy for your trading, then this right here tells you how much it would take to get back to even. And this is why you want to manage your the overall risk in your portfolio. If you are risking now 5%, it's going to, all you need is 5.3% to get back to even. That's pretty easy. If you're risking 10%, then it's going to take 11.1% to get back to even. Not too bad either. But then once you start to get beyond that, like it starts to increase exponentially, and it makes it far more difficult to get back to even. So what you want to do then, and what I recommend doing, is keeping your portfolio heat low at manageable levels, and figure out what is the worst case scenario for your trading. And that's also why it's so important to take good notes and to journal your trades, so you know what the worst case scenario for your trading has been. Well, what is the biggest drawdown that you've had? Have you had 5 losers in a row? Have you had 10 losers in a row? Have you had multiple gap downs against you? Well, what's been the absolute worst case for you in your trading? If we go back to me for what happened this year, the so far the worst string of losses that I had were 4 losers in a row, and I did have 2 trades gap down against me. So I'm trading it in a very conservative way. For me, I don't want to have more than 5% portfolio heat at any one given time. I also am trading it in such a way where if the entire market collapsed, right, and let's say all of those trades gap down against me, where I would have 2R risk, that I would lose 2R in each trade, then I'm only out 10% of my entire portfolio. Again, that's pretty conservative, and I'm actually starting to think that I could be a little bit more aggressive in my position sizing. And again, that said, it's something that would need to be tested out first. So that way, when you're actually in a trade, if you're doing something for the first time and you're like you just have an idea and you try to execute it with real money, that's when all the doubts start to come into your head. That's when all those voices, your inner voices, start telling you like, oh man, like I don't know about this. Man, maybe I did something wrong here, and that's when you start to see your plan fly out the window. And the reason why, in this case, would be failure to backtest. Backtesting helps give quite a bit of confidence. So let's see some actual examples of this in practice. So let's come back up over here. Let me share my screen number 3. And let me show you the trades that I'm in right now. So I've got all these open trades. I've got 5 open trades, but in my swing trading account, and I like to manage my trades here in TrendSpider. And the reason why is because they give this, you see that little halo around that level that I've marked as 2R. Well, first, that's the level where if I've made 2 times my risk. I've already made 1 times my risk in this trade, the service now, and if I get to $500.60, I would have made 2R. What TrendSpider allows you to do is to put a little buffer around those levels. So let me come over here and take the fill off. So like if I wanted to right click on this and create an alert around here, this is the sensitivity around that level, where if it gets within that range, I'll get an alert saying, hey, you're starting to get close to your target. And for me, I'd like to have a close enough level because if I'm close enough to my target, like I don't want it to allow it to reverse and fall all the way back down and lose out on those gains. So that's why that's there, and that's why I like to manage my trades in TrendSpider. I see a question from Chet. If you were a trend trader in less volatile stocks, would you think about heat differently and take more risk? That's a good question. And I think that what I would do then would be to do this, go back to the back testing and see what would change, right? Like, so I would have my spreadsheet set up, and I would set it up in a way where like right now, like this is one test. that I'm doing, right? When I'm ready to do my next test, I'll open up another tab, take these same trades, put them in, and then within there, test one variable, right? So you only want to test one variable at a time. So let's just say with this back testing, let's copy this and throw it into this sheet over here. Right, so let's say instead of risking 1% of capital, let's say that we want to risk 1.5% of capital per trade. Let's see what that does to our sizes. It actually looks like, oops. Oh, that's interesting. That didn't work. Oh, I see. That's not a formula in there. Interesting. The formula didn't carry over. What if I changed this here? No? Huh. All right. So in any case, what you would want to do is adjust your position size in a new sheet and then just see what would happen to your result. To come back to this, to get the idea of portfolio heat in your head. So where I just came back from vacation last week. Well, when I left, I only had this position in BJ's. I wanted to have the least risk in my portfolio, so that way, like I don't want to have to think or worry myself about the market. Well, when I was away, when I came back, AMD, Amazon, and ServiceNow all triggered on the same day. And NetEase actually gapped a little bit above my entry, and my buy stop limit was a little bit too tight, so I actually missed out on that trade. But otherwise, I would have had, all of a sudden, I would have had 4R risk in my trade. I would have been risking 4%. So pretty close to that full amount that I would want to risk in my portfolio at any one time. So what actually happened then, I had AMD, Amazon, and ServiceNow all trigger. So 3% risk. Pretty quickly, what happened was so it executed on Monday, and all of them reversed, right? So when trades execute and you see all of them reverse on you, that could be a little bit scary if you don't know your system well. And again, that's why I'm such a big advocate of going and testing your strategies, journaling, and so that way you could see how things tend to play out, and your mind doesn't have that recency bias of like, oh man, the past couple of trades didn't work, or oh my god, like the last few trades have made so much money. I've turned a corner. I'm now at trading God, and I could do no wrong, right? Like that. That's what kind of leads to that boom and bust cycle for so many traders. It's that lack of perspective. So if you are journaling and you review your journal regularly, you can see like, well, having periods of many wins is normal. Having periods of big wins is normal. Having periods of some drawdowns is normal too. It's all part of the process. And so here, all those trades came in. So on now on Amazon, like it broke out, it reversed back, and same deal with AMD on that Monday. Then on Tuesday, they started to rally, and in ServiceNow, it actually hit my first target, that 1 hour target. So I started to take a little bit off, and I'll share with you my my game plan for it right here. So I hit the first profit target, right? Like on this trade, I'm risking just under $1,000 on this trade, 890 bucks. And I've taken that position size trade management algorithm from here. 50% of my position is dedicated to the profit target. 30% is dedicated to backstop or trailing stops, I should say. And that last 20% is going to be dedicated to the backstop. But once that 1 hour target was triggered and started to move higher, I was able to raise my stop up to break even, because at that point I had a significant gain in the position and I didn't want that trade to turn into a loss. So worst case scenario, I would have exited with a little bit of a win if ServiceNow just completely rolls over. But in me raising my backstop, now I don't have that initial capital at risk anymore, right? So when this trade started, I was risking 1R on this trade, right? Like my initial risk was that 1 unit of risk. With me raising my backstop to break even, that risk is off. Does that make sense? How the gas stove of our trading, how the heat was turned down just a little bit, and now that unit of risk is not there anymore. Does that make sense to everybody? All right, so then the same thing with Amazon, right? Like Amazon didn't. Amazon actually did hit my my profit target yesterday, the first profit target, but it didn't have anywhere like it would just be awkward to raise my stop up to break even at this point. Price structure is actually still down here. Like that's still the significant low right around that 3,237 level. So for now, I'm keeping my backstop there. So I went from risking a full 1R on this trade to risking about half an R on this trade. Then I look at AMD, right? AMD started to advance as well, got close to 1R, didn't quite get there. Now it's kind of close to the buy point, but it advanced far enough where now all of a sudden this bar right here is the significant low. And I placed my stop loss just below my backstop, I should say, just below that bar, and it's sitting at 78.90. So I raised my stop loss, and now I'm risking a little bit more than half an hour on this trade, but altogether, as far as my initial risk goes, I only have initial risk left on AMD. I only have initial risk left on Amazon. And so I'm only risking about 1% of capital. So if I want to be able to risk up to 4% of my trading capital, or up to 5%, I should say, then that means that I've got 4R to play with. So that means that I could go through my trading list again, right? So I've got this watch list that I keep called Interesting Ideas. There's about 150 trade ideas on here. and I could go through the whole thing and see what's setting up. And do I want to put on more risk? Are any of them worthy of that risk? If they are, great. I've got the ability to go and turn up the heat a little bit. If not, then I don't want to just start throwing money at trades because I happen to have that in my account. That's why at the top of this too, we wanted to try to figure out what's a high reward to low risk trade, what's a high probability trade. Well, what looks good? Well, within the trade evaluator, when we take all of this criteria and we're evaluating a trade, what's the score of the trade? Right, like for ServiceNow, it scored an 8, like a little over an 8 for ServiceNow. AMD and Amazon both scored 7s, a little bit higher than 7s. Same thing for NetEase too. Tesla was off the charts, right? Like Tesla from a couple of weeks ago, and look what Tesla's done, right? Like breaking out from over here, and now it's almost hit its what would be 4 times the initial risk. Incredible move, and it's been so smooth. It hasn't even triggered a trailing stop yet. So let me know what questions you guys have at this point, and well, we could what I like to do too, if you guys have trades that you are looking at, let's look at them. We could construct a portfolio and see what the heat of that portfolio would be.
So, Mike, I've got a question that's similar to your AMD trade, in that often you get trades that they go up a little bit and then they slowly start to drift lower. So do you ever look at just taking some of that position off to minimize the risk rather than moving the stop?
Yeah, absolutely. That's what the trailing stops are. Do you have an example? Or would you like me to go?
Not to hand at this PC, but a few months back, maybe mid-June, there was quite a few that they seemed to break out, and then they just kind of failed and slowly faded back. And
well, that's what I think that BJ's is actually a pretty good example. So we could flip between, like I actually like the display of TradingView a little bit better. Like it lets you zoom in even closer than TrendSpider does. So we could flip back and forth. Like I've got the plans written in TrendSpider, but I think it might be easier to look at TradingView. But anyway, so when BJ's broke out, and I'm using the 5 EMA, the 10 EMA, and the 21 EMA as those trailing stops, like it ran over here, right? And then it closed below that 5 EMA. So I'm selling a little bit right there. Like I didn't know that we were going to end up over here. The only thing that you know is up to that point on that day, right?
Yeah.
So one of the ways that I manage my risk is because from my own trading results, like I know that it's better to have smaller losses than it is to for me to have a much bigger win on this side, both from the management of the trade itself and also how my trading personality has developed over time. So I'm taking a little bit off right there, right? And at that point too, I had made at least 1 times my risk, and so I'm raising my stop, right? And so my stop at this point, let me see if I still have, actually, no, I just moved the stop. So my stop was probably either here or probably would have been moved up to closer to break even right at that point. Like actually, yeah, now that I'm seeing this, like that low right there, if I'm hitting 1R beyond 1R, I would probably raise my stop up to either this low or maybe that low if I'm like, oh, maybe I'll get shaken out there. But it's using the moving averages uh, to act as trailing stops, because remember the moving averages are helping you gauge the momentum of a trade. And if one of your goals is to be in high momentum trades, then it should be holding the shorter term moving averages. So here it lost the 5 EMA. Didn't know if it would come back and start closing below the 10 and the 21 lot. Like it could have very easily come back in and started to retest the 50. In that case, I'm losing interest in that trade. Like I don't want to wait for it to test the 50-day. I would rather exit that. So I'm exiting a little bit right there. It starts to run up. Okay, fine. Still holding it. Then over here, it's closing below the 10. So I'm selling a little bit more on that day. And it consolidates some more. So I'm still sitting around there. My stop loss is still back here, and then it starts to move up again. Great. Now that it's moved up, now that it has that significant low, I'm raising that backstop, right? So the remainder of my position, if it were to fall below that level, would be taken out of the entire trade. Runs up, comes back in, and over here, it's closing below the 21 EMA. So I'm selling a little bit right there. I'm still have the portion of the trade that's dedicated to profit targets. I still have the portion of the trade that's dedicated to the backstop, but it's all back here. Trade continues to move up. It runs. We have earnings, and now it's trading above the 5 and all that. And I'm still in the trade, but my risk has been minimized from giving this portion up back here. The rest of the trade is at in profit, and the money that was taken off of this trade is able to be redeployed elsewhere. Like there's no initial capital risk in this trade at all. So if I'm looking at BJ's, like I have 4 positions on, but my initial risk is only 1% of capital.
Yeah, I'll maybe need to do some back testing. That when I looked at mine, I tended to find that I had like full 1 hour stops every time for when I was getting stopped out. So I instituted a rule that if after 3 days I was below my entry price, I would cut half and let the other half go to the full stop. So, and that certainly improved profits, but it's not very subtle, I guess. So in that BJ trade that you showed, I would have taken half off on day 3.
So
not including your entry day. So 1, 2, 3, that 4th day I would have been probably taking some off. Yeah.
Yeah, there's been a lot of trades like that. So like so if you have something like that, like what I would suggest doing would be to going back testing and to see like whenever shortly after entry, whenever that happens, what would your results look like if on every single time you took off half the position, right? Because there'll be some times when that happens, and maybe you're right, and there'll be other times where you get like a PayPal where it does that move, right? Like it breaks out, you're out of half of the position here. Then it comes within 2 cents of hitting your full stop, and it then goes on a tear.
Yeah. Yeah, I mean, half the time you're right, half the time you're wrong, I guess, and that's how it kind of works. But yeah, it's worth a look at.
Yeah, back testing is one of the best things that you can do for your trading.
Yeah, I only tend to do it once a year, so maybe need to do it more often.
You know, like for me, like I'm working on this spreadsheet every day, and it's taken me a while to do it. Like I'll do it during that first hour of trading. Like I'll log in, check the Traders Mind chat room, check the market, talk to you guys, and then I'll be working on this. But yeah, like there's so many benefits to it. So many benefits. Question from Chet. Mathematically, what is the limit in dollar percentage you would ever have on? 50%, 75% of total dollars available to trade? Is it any different if you have a margin account? Fantastic questions. So for me, the most that I would of my so working off of an account with 100 grand, the most that I would probably have in would be around 30% of that capital in any one trade. Beyond that, and you start to run into significant overnight risk. So let's say, just to bust this open again, hopefully it loads quickly. Oh, got an error. Oh, we've got, because we have it open already. Okay, so let's say that I'm coming back over here using 138.90. We've got 17% capital up. Let's just say that we bump this up to risking 2%. Right, and now we're risking a third of our capital. That puts it into that sweet spot where you you're risking enough and you're able to make progress. But notice how I did that, because I'm risking more of a percentage of my capital on this trade versus like in order to do that, now I had to risk 2 grand versus if you did it another way and you're risking 1% of your capital, but you have a much tighter stop loss. Like let's say your stop loss was at 144. Right? Then your positions, actually, let's drop it a little bit. Let's say 143. Yeah, 143 gets you to the same spot, but your position size is about a third of your account, but you're only risking $1 grand. That's the way that I would prefer to do it. Having a tighter stop loss, but only if that stop loss is significant on the chart. Like if we're looking at say PayPal, just since we're using that example, like I wouldn't just raise my stop up to here to get that tighter reward to risk. Like it needs to make sense structurally. And the first thing that I'm looking at for setting stop losses is going to be based off of price structure. The pattern that's here, I want my stop loss to be below a significant low that ideally it coincides on both the daily and the weekly time frames. Then I'll look to see what other levels coincide. Are there moving averages? Are there, sometimes we'll have Fibonacci retracement levels. Since it's the low of the pattern, there's not going to be a Fibonacci retracement level. Is there a major psychological number, right? Like is it 100? Major round numbers, things like that. And all those things go into the strength of that stop loss, where if you're checking off all the boxes, you should be able to drive a truck over that that stop loss that you placed. And if the truck falls through, like if there's a sinkhole in the road, then you shouldn't be driving on that road. You want to go somewhere else. So yeah, about a third of the account. And then the way that I'm using margin would be I would only be using margin if I run out of capital to trade. So like let's say we come back over here and another trade gets executed, and then a third or a fourth trade. So I've got, what do I have? I've got 4 trades on right now. Let's say I enter a 5th trade tomorrow. Then on Monday, 2 more trades execute, and I keep on, I'm able to raise my stops. The market is doing fantastic. And then, all the cash that I have is already tied up into trades, and my trades are working well. I don't have any initial risk on. That's when I would start to use margin to add to the position. I wouldn't be looking to just take on more risk. It were to expand my initial risk. It would be adding positions when things are working, and only when things are working. Does that answer the question? I hope that I was clear enough, but glad to try to go deeper. Yeah, so Chet, the total risk that I would be willing to carry at any one time is 5%. So 5R risk on the total portfolio. And so if we were looking at say none of these trades moved yet, right? Like, so I started out with 4R, then that would mean that I could add 1 more trade to that while I have while I'm at 4% risk. I'd be willing to go up to 5% risk in the portfolio. As those trades advanced, then I could add more risk to it, and then I would start to use margin if I ran out of capital. Question from Sal. Can you look at AMD and let me know again how much you have risk on AMD? Sure. So on AMD, I raised my stop up to 78.90. So that is roughly like just eyeballing it, it looks like it's about maybe about 0.6R risk on that right now. So it went from 1R to 0.6R. Anthony, so if you had a $100,000 account, there is a scenario where you would have all 100K invested. Yeah, absolutely. There's a scenario where I would have 200K invested using full margin. But I'm only adding on the heels of trades working. So if I have 5 trades on and they haven't moved, I'm not looking to add another trade to that yet. I would have a maximum of 5 trades on. I would need them all to advance, just like how like if, let's say, BJ's wasn't working, or like we saw on last Saturday's deep dive, how there were just so many great setups where it's like, all right, like I want to put up to 4 trades on, and I came up with the action ideas list that got sent out to everybody. And then it was like, all right, well, we have these all executing, but I wouldn't look to add additional positions until these ones all started working, right? So let's say all of them were still kind of futzing around. They didn't offer a way to raise my stop on them, then it would be like, all right, I'm gonna sit on my hands and wait. Because even if another trade looks great, like these trades look great. In fact, I've built a tool that's trying to tell me that yes, based on your system, based on your beliefs of the world, that it scored this, and this should be the highest probability trade in there. So if the what I'm viewing as the best trades aren't working, then I should not be looking to add. And that's the same deal for you. If you have your criteria and you have your checklist, and you're like, wow, this trade let's say AMD checked every single box that I'm interested in. Great. I'm going to go put that trade on, and then it goes nowhere. And then let's see, you say, I don't know, PayPal is breaking out, but PayPal only checks 5 of the boxes, but it's like, man, like now I'm all into PayPal. Well, the trade that you thought should be going, that checked every single box, didn't move. So should you really be that enthusiastic about jumping into another trade when your first idea didn't work yet? That's what would give me pause. So it's adding when things are working and not adding when things aren't working. And if I start to see that, wow, there's so many other trades that are working and the trades that I think are the best aren't, then that's something to go back and like if my system were brand new, yeah, like some doubt might enter into the head. And so what do? Do you just toss what you did out the window and start chasing trades? Some people might. I don't think that it's a good idea. What I would do would then be to go back and test and try to figure out, well, why are these other trades working and the trades that I'm putting on aren't working? What types of adjustments, what types of tweaks do I need to make? It could be something into your position size. Maybe you're only risking 1% on trades. Maybe you should be risking 2% on trades. Maybe it should be, maybe you should be managing the trades in a different way. Maybe you're taking off too much if a trade reverses against you. Could be a variety of different things. But the way to get to the answer is through testing. Anthony, do you ever drop a trade that hasn't moved for another better looking fresh setup? Yeah, so basically that answered the question, but also built into the way that I'm managing trades. Like if we're looking at this like AMD, right? Like, so if it's just going to chop around forever, whoops, didn't mean to move that down. Like if it, let's just say it starts chopping around forever, that's when the moving averages start to catch up to it and it starts to close below those moving averages. So I'm naturally scaling out of positions because I've set the trailing stops up as moving. I've set the moving averages up as trailing stops, which makes them time-bound stops. Eventually, the 21 EMA will catch up to this level if it just sits there. And so I'll be stopped out of a third of the position. And then if it starts to break down even more, there'll be another level of support and I'll be stopped out of the position. On average, I'd say that if a trade is a loser, I'm out of the trade within about 2 weeks. Just because moving averages catch up to it and then it starts to break below different support levels. All right, any other questions? Any other questions? All right, so we had this blocked for about 90 minutes. we're about at that mark. So yeah, if you guys don't have any other questions at this point, we'll call it a wrap. All right, so I want to say thank you guys for joining. I hope that that was helpful for you. If you think of other questions after we're done, just like, oh man, like I wish I would have asked Mike that, just shoot me an email. Right? I believe you all have my email at this point, mike@marrowwealth.com. If you ever forget my email, you could just come back to the site, the marrowwealth.com site, and then go to the contact us button down here, and then just fill in this, and I'll get your email that way. But yeah, feel free to drop me a line, ask questions, go to the Traders Mind chat room, post questions in there, and I'll be glad to answer them for you. Also, if you wouldn't mind, let me know too what you thought about this session. Let me know if you liked it, if you didn't like it. Well, what could make it better? We're constantly, like, I'm trying to improve our offerings to you all as well. And I want to make sure that we're providing the best value. So yeah, let me know what you liked, what you didn't like, what you'd like to see next. All right. That's it for now. Thanks so much for coming and being a part of this, and I'll see you in the next deep dive. All right. Take care, everybody.
Thanks,
Much love.
Cheerio.
Peace out.